Welcome to the show, Ferdinand and Thierry.
Thank you. Thank you very much.
Yeah, very excited to get into these anticipated questions. So, last week, the National Bank of Rwanda had its, Financial Stability Committee and Monetary Policy Committee press conference. And this is where the governor shares key decisions on the monetary policy side and, the state of, the country's financial stability. But I feel like now people want to know, who's a part of these committees, the decisions and updates they give, how do they impact, let's say, consumers, businesses, or just the country? So, I shift this question to the both of you and walk us through that.
So as you said, we had a meeting of the Monetary Policy Committee joint and also the Financial Stability Committee, two different committees, but which actually meet around the same period. I'll let Ferdinand explain for the Financial Stability Committee. The Monetary Policy Committee is a committee that is established by law, responsible for making decisions regarding monetary policy. And monetary policy is the policy that the central bank is using to manage inflation and to achieve the objective of price stability. So our objective for price stability is to ideally have inflation increase in prices around 5% in the medium term, but within a band of 2 and 8%. So monetary policy decisions are taken to actually achieve that objective. The committee is, as I said, established by law, made of 9 members, of which the chairperson is the governor. Deputy chairperson is the deputy governor. We have also 2 other members established by law, the chief economist and the executive director in charge of operations. And the other members are appointed either by the board of the National Bank of Rwanda or by the governor if they are staff of BNR. Monetary Policy Committee meets on quarterly basis. And it's a whole cycle made of 6 weeks of preparation, 3 different meetings until the last meeting. And it's supported by a whole team here at BNR, mainly in the Directorate of Monetary Policy and Research, who is preparing all the economic analysis and the presentations, mainly about what has happened to the domestic economy, to what has happened for inflation in the country, the global economy, the external sector, our relationship with the rest of the world, our fiscal sector, etc., etc. So it's a very detailed presentation, and that's done as the first meeting, first pre-MPC, followed by a second, also detailed presentation on the projections. What's going to happen? What do we see in terms of inflation, economic activity, etc.? And this is helping to actually see if the inflation objective is going to be met and what to do for us to meet that objective. That becomes now the monetary policy decision.
Okay, maybe we'll first, go ahead and listen on the financial stability side.
Yeah, thank you so much. Financial Stability Committee is also a statutory committee, meaning it's established by the central bank law. It's in charge of implementing the second mandate of the central bank, that's its sound and stable financial system. It's chaired by the governor, and deputy governor is also the member. It's also attended by different high personalities at the central bank, including the chief economist, executive director of financial stability, executive director, banking operations, and directors in the supervisory departments. So it meets on quarterly basis to deliberate, discuss, assess the conduct of financial sector in general, and assess whether there's no risk that can affect the conduct of the financial services and products.
Yeah, so, Thierry, if you had to summarize, the monetary policy decision this quarter in one sentence, what would you say?
Decision, maybe just its context was to increase the central bank rate by 0.25% from 6.5 to 6.75. So if I have to summarize it in one sentence, I would maybe say that by this decision, the Monetary Policy Committee wanted to keep inflation within the target band under control so that it does not have negative impact on the consumer's purchasing power.
Okay. Yeah, I think that's a straightforward, direct way. Switching gears to the financial stability side, Ferdinand, when we say the financial system is stable, what does it actually mean? Let's say for a country or again, a business, a consumer. Yeah, break it down for us.
Basically, it means financial institutions are able to provide financial services and products efficiently and effectively. This is to mean banks are able to provide loans and to collect a deposit and provide other essential services, financial services to its clients. Insurance companies are able to undertake the compensation of damages, losses, illness, deaths of their clients. So simply it means that clients are getting efficiency and effective services and products.
Yeah, I think that is definitely a good breakdown. I also feel like it gives us clarification on that statement when we always say that the financial system is stable. I think now people have more insight into what we actually mean. So, during the press conference, we saw that inflation is expected to be within the target band. We saw 7.1% in 2025 and then 5.6% in 2026. So, someone can be a business owner, someone can be a farmer or even household. What does this mean for them, or would this impact, walk us through that?
Mm-hmm. Yeah, I think it all comes with, what you are trying to, our main metrics here, which is inflation. What is it? Inflation is the increase in price. But really when you talk about increase, decrease, change in price, we need to have a reference period, right? So price of today compared to what? And when we talk about inflation in general, we compare to the same period last year. So inflation in the second quarter, which is the period of April to June, compared to the same second quarter in 2024, is 6.7%. Means that prices have increased by 6.7%. As I was saying, what we don't want inflation to exceed is 8%. And we actually also want inflation to not go below 2% because that will also be no incentive, let's say, to produce or no incentive to invest on the supply side. So in a nutshell, that's basically what is going to be the perfect level of inflation between 2 and 8, ideally 5, to support economic growth and development over the years. We've had periods where we had very high inflation in 2022 and 2023 due to different factors, can come back to. But now in 2024, since the beginning of 2024, we had inflation that was really within that range, actually even closer to 5%. It's only the past 2 quarters where we saw it slightly increase to 6.7. And in July, the latest numbers we have, it was at 7.3. So with that into account, this is what you said in terms of projection. So when we project, you take into account what has happened recently. Since last time we had the MPC in May, we have new data for May, June, July inflation, but not only for other economic indicators. So you take that into account and you try to see if there are assumptions of what is going to happen going forward on the global economy and many other economic indicators. Are they still the same assumptions or things have changed? And this is why we do it very regularly. So our assessment this time was to revise upward the projections based on the most recent development. But still, the main message, as you said, what does it mean for people? The main message is that despite that inflation is slightly higher in the recent period, this inflation is projected to remain within that band of 2 to 8%. So on average, we are projecting now inflation at 7.1 in 2025, and then it's going to reduce to 5.6 in 2026. We can go through the different reasons why. But basically, the revision is coming from the recent development, but we also have a trend, for example, of international commodity prices, let's say fuel or food products that are transacted internationally. Their price is actually falling down now. This is going down and it's projected to keep declining, which is a good sign for the products that we import. So these are some of the factors we take into account when we do our own domestic economic projections, including inflation. So what does it mean? I'll come back to that. It means that inflation, although it has slightly increased, it remains stable. And the decision of the monetary policy to adjust the CBR is to make sure actually that this happens by increasing the central bank rate, the main policy rate. So we are affecting with a lag, yes, but we are affecting inflation that is going to happen in the coming months so that it remains within that band.
Yeah, that's a valuable breakdown. It's interesting. When the press conference always airs, my friends will come and be like, so what does this mean for my business? Am I going to be broke? So I hope this gives them a vision into that. So, risks come abruptly, and, for Rwanda's financial system, what are the main risks to it? And, how do you monitor them?
Well, the financial sector is a subset of the overall economic sectors and is part and parcel and highly interlinked with the other sectors. It is linked with the real sector, the fiscal sector, monetary sector, external sector. So in our assessment, we usually do assess all those linking with what the economic part has done and then try to understand the situation of each and every financial institution. So risks that might come from the economy, the economic performance, economic growth, can easily affect the conduct of financial institutions. So in our recent assessment, we tried to assess risks that could, affect the conduct of these financial institutions. One, we saw that funding is the main risks, which might come from what is happening on global scale. Globally, we have uncertainties going around with the trade war and government increasing their debts. So funding from abroad would be very expensive as we move forward. And again, this might also affect our market locally. Again, we have also identified equity prices, uncertainties around equity prices, and we have our local institutions that invest in equities abroad. So with the price correction going forward, stemming from the trade war and the uncertainties around the tariffs, might also affect the equity market, which would also affect the earnings or profitability coming from the investments abroad. Again, locally, looking, for example, in the banking sector, we also assessed the level of concentration, lending concentration. We saw that our banks really lending to similar people, to few sectors of the economy, which might create risks going forward. That is a concentration risk. Again, we have seen the adoption of digital finance, digital transactions in our financial institutions. Operational risks is going to be our main risk again. This is because as institutions digitalize their services, it goes with risks of fraud, cyber attacks. So those are key risks that we identified.
Yeah, you talked about global, and this is my question to you, Thierry, as well. With the global economy, which external risks usually impact Rwanda the most, and how do you mitigate them?
They're pretty much similar to what Ferdinand was explaining. As we are living in an interconnected world, and what's going on internationally can affect us as a region in Africa and even us in Rwanda. There are some examples. We are talking about high inflation in 2022. It started with the war in Ukraine, where because Ukraine was mainly producing, was one of the main producers of things like wheat, involved also on fertilizers and some other commodities. Russia was involved on fertilizers. This region was affected. And the supply, including also fuel, the prices went up for almost all these commodities, affecting everyone. That's how you saw high inflation everywhere in the world. So right now, we are very mindful that if something like that happens, I can even talk about a very recent example. You saw the very short war between Israel and Iran. That in very few days created really panic on the market. Oil prices went up. Luckily, it didn't last. It was just a couple of weeks. Then after that, the situation stabilized. But if it had continued, then we would have seen consequences on import of fuel. It would be more expensive. Then here means you would see that Rwanda would need to revise the fuel pump price up and things like that. So concretely, it has a very, very direct implication for people. And that's why we need to monitor this very carefully. And we always talk about it as a risk. So global geopolitical tensions, which involves war and other things, even these trade wars you're talking about, means the decision by the US to increase the tariff on X or Y country affects the relationship, trade relationships, can affect supply chain, can affect international commodity prices. So we are monitoring all that, and we know we have a better understanding. We do research on that. We have an understanding on how this transmits to our domestic economy and how fast. So if something happens there, we are able to anticipate. But unfortunately, we are not able to anticipate what would happen. Yeah, so we are able to anticipate if that happens, maybe the impact will be that for us. Then that means we need to react. How do we need to react? By doing something maybe on the monetary policy side, but not only, there are other things that other institutions in charge of economic policy can do. So we prepare, we do research, we do analysis that we also share with colleagues from different institutions. And this is what happened during the period of the war in Ukraine, where you saw the government taking different initiatives, where we were also part of. And the same, I believe, will happen if such a shock happens again.
Yeah, as we're talking about how these risks are, mitigated or, they're monitored, I think of, digital finance, as you actually mentioned earlier on. I also think of fintech. So, are these more opportunities or challenges for the financial stability?
Of course, yes. There are a lot of opportunities around digital transactions. For example, we have efficiency in doing business. We have also effectiveness. And also digital transactions are also bringing conveniency. Financial institutions happen to leverage from digital transactions, digital services. They will gaining more from their services. There are also challenges, as I pointed out. Digitalization also is bringing about cyber risks, cyber attacks, fraud. And this is due mainly to a level of understanding of these digital transactions. So we need to educate our people, our citizens, to be able to know the risks pertaining with digital transactions and understanding how working with the financial institution digitally and the risks they could bring about.
Yeah, before we wrap up and I let you both go, I have one question. If you were to have a coffee with a friend and, they asked you on the monetary policy side or the financial stability side, how do they work hand in hand to ensure Rwanda's, economy is stable and resilient? What would you say?
I think let's, at the end of the day, see the broader objective, right? We are a developing economy, Rwanda, and we are actually developing very fast. And that's the objective of the country, to move from where it was 30 years ago to not only where we are now, but where we want to be in 30 years to come. We have the Vision 2050, we have the National Strategy for Transformation that I think everyone knows. So the prerequisite for that, for you to grow economically, socially, etc., at a very high pace in a very long period, you need to, at the same time as you're growing, you need to have what we call stability, which is, on the economic side, we call it macroeconomic stability. The central bank, including the National Bank of Rwanda here, is responsible for actually a big part of macroeconomic stability. In its mandate, price stability and financial stability together part of macroeconomic stability. So the decisions that are taken by monetary policy in terms of supervision, financial stability, all to ensure that this stability remains so that the economy can grow in the long run. So that's what I would say. I don't know if it was...
No, it was. That's a good answer. Yeah, that's a good answer on the financial stability.
No, definitely. It's a good answer because, as he mentioned, the financial stability or the financial sector is part and parcel of the entire macroeconomic sector. So it relies more from whatever the economy is bringing, in whether it's performing, the financial sector will be performing, and the decisions that are taken by the monetary policy do affect financial institutions in one way or another. So it's closely linked with the other sectors of the economy, as he mentioned.
Yeah, understanding, how inflation is managed or how these risks are monitored or mitigated or, the leverage of technology, it shows how, the Monetary Policy Committee and Financial Stability Committee, work hand in hand to ensure, Rwanda's stability and resilience of the economy. So, thank you for breaking it down. And
On that, actually, if you allow, just it's also one of the reasons why we tend to have these meetings happening during the same period. So exchange information. Ferdinand said, I'm a member of Financial Stability Committee, and the Financial Stability is member also of the MPC. So basically, we are working very closely, and a decision taken on the MPC side, we analyze what possible consequences for the financial sector and what else can be done to ensure both at the same time price stability and financial stability. So I just wanted.
No. That was a good conclusion, actually. So yeah, thank you for being part of the show and being part of, the podcast. So thank you.
Thanks you very much.
And that's a wrap on episode 19 of the NBR podcast, where we remain committed to breaking down complex economic topics with clarity, less jargon, more relatable, real-world examples. But before we go, remember to share with a friend and let's keep the conversation going.